Today, we're talking about the problem with it, which is the question, how does banking, which is the activity of banking, represent a problem, and how does it affect my wealth plan, Kyle? So that's the conversation we're talking about today. That's part 2 of the series. So like I said, May 2026, we'll share the recording or the link to that. If you missed that, please go watch that. It's going to be a step-by-step instruction on how to think about your financial habits with the Path of Money and the Tough Money curriculum. And then today we are here again to talk about the problem, Kyle, which is one of our favorite topics. It's what brought us together. I think everyone in this community likely.
Yep, I think we all got a hold of this book right here, Becoming Your Own Banker, written by Mr. Nelson Nash. And when you read this book, it's really hard to unlearn or unsee some of the concepts that are written in there, because they're a major paradigm shift, I think, for most people. But once you see this idea that we call the problem, this banking problem, and how that affects your wealth plan, you can never unsee this ever again. So let's do a quick recap, David, of what we went over last month. This is part 2 of our 3-part series for this summer. And you've seen this model if you've been following us for any number of time. We call this the Path of Money. There's really only 4 things we can do with money as it flows into our life. We can spend it, we can donate it. What's left over is typically called savings. So the 3rd thing we can do with money is hold it. Now, where you hold money makes a remarkably big impact on your wealth plan, with the 4th thing being investing it. Now, everyone wants to be doing the investing part. That's, I think, the really cool, exciting things. Yeah. But you can't get to that point if the front part of your money is out of sequence, or what we say is your path of money is off. If your path of money is off, you're going to have a really hard time getting to that 4th thing. And that 4th thing is really what's going to create all the freedom in your life. Everyone on the call tonight is at a current wealth starting point, and you want to go some current wealth destination in the future. It's where you are and where you want to be. And understanding this path of money, I can promise you, will help you bridge that gap with less time and with less risk.
So the question for today, Kyle, was how does banking affect my wealth plan? And the conversation we're going to have today starts with this. You need the May recording class so you know where you are. So the starting point is, where are we? And as long as you know rough numbers, the most important, your income, your liquidity, your net worth, you can start to size your path of money. And with more help of our team, as a family, with your business partners, you can add more information. How much are you spending, donated? If you go one more, you'll see the more detail, the more fidelity you add to this model, the more clearly you'll understand where you are and how to decide what progress looks like. Very powerful model. More importantly, Kyle, once you understand where you are, you can then determine a goal and understand that there's levels to get to that goal. And more importantly, even ask, what's my next best move? For most of us, that question feels like this. And if you see this on the screen and you relate to that, it's not just happening to you, it's happening to all of us. There is so much noise in this conversation, and we all need models and systems to have more clarity around this conversation, which is why we want to bring to you the Tough Money levels as part of this curriculum. That was the conversation we had in May. So if you want access to understanding how this framework works, how it may apply to you, how we can help you answer what's your net worth, the next level, and your next best move, I cannot encourage you to please reach out to the person that invited you to this seminar and go and get the link to the recording. As a matter of fact, we might be able to share with everyone right away. So the Tough Money Habits Changing Middle America conversation from May, if you scan that QR code with your phone, you'll be able to go to the YouTube channel for Factum. Please subscribe and give us a thumbs up. It helps us continue to put content out there. You'll be able to access that conversation. Wonderful conversation. So that's the ground for today's conversation, Kyle. We need to understand where we are.
I love it. And everyone on here, they're at a certain point. They want to go to a higher net worth, more passive income in the future. So naturally, the question is, what principles, what strategies, what frameworks, what products would I put into my wealth plan to help me achieve that?
Correct.
I think everyone on the call tonight has probably done a lot of really good things financially. And then there's a lot of us that have always felt like it could have just been a little bit better. And this banking conversation we're going to have tonight, the problem, how does the world of banking affect my wealth plan? This is that piece that I think a lot of people have been looking for. This is the piece that makes everything just a little bit better.
Yeah.
And when you apply the right formula to this conversation tonight, that little bit better over time becomes an exponential wealth curve. And this is going to unlock an entirely new level of freedom for everyone on the call.
Yeah.
So let's go back to this path of money, David, and let's reorient ourselves to what's going on here. If we were to strip everything off that screen. What's going on here? Money's flowing into our life. We all have an active income. How do you think about that?
So when we work for money, what we're doing is bringing new money into the equation, okay? That's new money. And the premise that we should start with is, if we're going to ask ourselves how banking affects our wealth plan, let's define banking. Banking is an activity. It's not the building in the corner of your downtown city, okay? Banking is an activity, and we want you to think about it in terms of controlling permanently money. As a matter of fact, we define banking as the ability to keep permanent control of money with access to it, okay? So what if we just start to size the problem by understanding what's our opportunity for total permanent control? In an ideal world, Kyle, we would be able to close our income statement and have no leaks, okay? And we would be able to capture 100% of the money we earn, and we would be able to move it to our balance sheet to have 100% control. But this doesn't lead to a life of abundance if we think about our 5 areas.
Well, how is the IRS going to get their money if we don't pay taxes, right? We can't just save and keep everything we're earning. There's people out there who got to get paid, right?
Yes, and we need to spend, we need to give some, we need to also invest some to continue to grow and accelerate. So this is utopia, but this is an important recognition. This is how we size the total opportunity we have. And now we walk backwards. There's 2 types of people in this conversation: people that want to think about total control and people that are going to go the opposite way, not intentional control whatsoever. So when we think of permanent control, the average American, unfortunately, is bringing new money, Kyle, and spending most of it. Is leaking out of their hands, out of their family, out of their business. They spend 95% of the money and they keep 5%. Very little savings means very little opportunity to build a balance sheet and hold money, to hold liquidity, which is going to compress their opportunity to build wealth. This is the person, regardless of income, by the way, that has not developed the ability to translate income into building wealth in their wealth plan.
So if I'm picking this up, David, Americans loved it. We're pretty dang good at spending money. Some of us are semi-professional spenders, right? About to go pro. So we're spending this money and we're only saving a little bit. And that's why the balance sheet, the assets we actually own, it's just not heavy enough. It's not big enough. It's not strong enough to support any type of investing strategy. And this is why most Americans can't get ahead. We're looking at it on the screen right now.
Exactly.
This is a behavior issue.
That is a
first and foremost
behavior, which is why in May we talked about financial management and how your habits affect it. This has nothing to do with an asset. This has nothing to do with a banking. It has to do with the 6 inches between our temples, which is the most valuable real estate we all own.
And interesting enough, in the book, Becoming Your Own Banker, which is going to be one of the action items for everyone on the call tonight, Nelson, first third of his book, this is how you know this book is not a scam. Yeah. Because the first third of it is like, hey, you got to beat the human behaviors. If you can't save more money, if you can't be disciplined with wealth, basically he says, give up. Like, you can't become your own banker. You will never be a good investor. You won't be a solid business owner. Behaviors are the #1 things keeping Americans from reaching their financial goals.
Yes.
If you can't take that first fundamental step of spending less and saving more, which would kind of look like this, if we can spend less and increase our savings and expand that balance sheet of what we're owning, that's going to put you in a position to become wealthy. Mm-hmm. If you can do that part that we just showed right there, David, that's the first step. If you can just get that step down, you will win the money game. It's just a matter of time. Yes. If you can't do that, it's literally impossible to do anything worthwhile financially.
And I think the key to connecting the next step to this, which is the obvious solution, right? Spend less, keep more of everything you earn, is to now add to the fact that once we build liquidity, there has to be more to the equation than just having cash reserves. We need to be thoughtful about what we do with cash reserves. More importantly, if you read this book, you know the answer is going to be where you store your cash reserves. So one of the things you said at the beginning of the call, a lot of us feel that we've been doing the right things with money, but can be even better. A way to think about how to make it even better is to use banking, or where we hold money, to make our spending even more efficient with large purchases and to reduce low quality, low value spending, IRS, insurances, investment fees, or debt. Mm-hmm. When we do that and we further increase the efficiency of our spending, and we have the ability to keep a larger amount of money in savings and build even a larger pool of liquidity, this creates the opportunity for us to start building a significant amount of wealth in a compressed period of time.
There we go.
So very important. We call this, that you see there in the green box, my friends, the PC money. And I don't mean to say political correctness. I mean to say permanently controlled money. So if you want a formula for permanent control to define for yourself from your path of money, it's a combination of 2 things, Kyle. The right amount of liquidity being held in the right savings environment will give you the opportunity to permanently control capital.
Now, if you are using common savings environments, checking accounts, savings accounts, bank commercial products, you will not get enough benefits with those savings environments to do what we're talking about tonight. Nelson identified that in his book, Becoming Your Own Banker. There are foundational assets. We're going to do a deep dive on that next month, so make sure you tune in again next month, that give you additional benefits that allow you to permanently control wealth in your path of money. Imagine every dollar flowing through this path of money, and a portion of those dollars you're going to permanently control forever. It's a really hard calculation. We're going to help you with some math later on that'll help you get that calculation down, but it's literally worth a small fortune to every single person on the call.
Yeah.
So let's do some math.
Let's do it.
Here's the question we want you to do, and if you have a sheet of paper or you got through at least 6th grade like I did, we can probably do some of this in our head, okay? So if you added up all the money you've earned in the last 10 years, think about that question for a second. If you've been making $50,000 a year, $100,000 a year, whatever your income has been, average out for the last 10 years. So if you're making $100,000 a year the last 10 years, $1 million has flowed through my hands. That's through my path of money. That's income. It's flowed in. It's flowed out. The question that we need to ask is, how much of it could you access and write a check for today? Yeah. Now, I want you to do this calculation in your head and think of this as a percentage. So I'll give you an example. $1 million has flowed through my hands in 10 years, and I have $50,000 that I could write a check for and access today. That's liquid and accessible to me. That is, as a percentage, that is 5% of the money that has flowed through my hands in 10 years is what I could access and write a check for today. And by the way, we get to go all over the country, David. We've asked this question to thousands of people. Yeah. And we're not using Slido tonight, but that is an application we use to teach. Number one answer that we've seen with this question, no matter if the room is a bunch of 18-year-olds just entering the workforce, or the highest level masterminds that we're a part of, where everyone is on track to be worth $50 million in the next 10, 20, 30 years. Number one answer is 5% of this number. And it's not because we're not good at making new money or creating new money. It's because the skill set of permanently controlling money is a very different skill set. We were never taught how to think like bankers, how to control money. We've always been taught, be an investor, be a business owner, create new money, generate more income. These are very different skill sets we're talking about, and that's why everyone's answer is 5%.
And creating new money back to the IRS also gets our partners at the IRS paid. Interesting enough. But let me just make a point here just to double click on what you said. We just talked about the question at the top is the total permanent control. $1 million is the opportunity for total permanent control. And there's two reactions to this. It is very painful if my actual permanent control is only 5% or less. It is a very painful, but it's an important piece of awareness because it lets you know that banking as an activity has already been going for your entire life and will continue to move forward whether you want to take control or not. If your answer is yes, that check is big enough, you have been permanently control money and can be even better, Kyle.
I love it. So action item number one for everyone on the call, you got to go back and reread this book. If you've read it once, if you've been working with us already for a year, 5 years, 10 years, however long you've been with us on this journey, I can tell you when you learn new ideas, going back and getting some repetitions in, if you reread this book once per year, you are going to get a completely different message out of it every single time. Yeah. As you learn, grow, and develop, you're going to read pages that you're like, I never noticed that the first 3 times I read it. And what we're here to talk about, this idea of banking and the problem that it creates in our life. Now, Nelson Nash would sum it up this way. Here's the problem. You finance everything in life. Now, what he means by that is you either borrow money and you pay up interest, or if you were like me growing up, I was taught to pay cash. And I didn't learn that there was an opportunity cost to my cash till I was about 25 years old. And the issue is when you pay cash, you give up the interest you could have earned, not for 5 years, not for 8 years, David, but for your entire life. Yeah. That calculation becomes a compound effect that it's either going to work in your favor or it's going to work against you. We're going to cover that in just a minute, but it becomes a massive amount of money by not understanding this problem and the solution to it. And the real issue here, David, is all of these things in life are financed by someone else's banking organization.
Yes. Think about that. Liquidity plus a savings environment. exactly what Nelson is identifying there, Kyle.
So action item 1 for tonight's call, because we're not just here to talk about education. Education is worthless without implementation. If you don't have this book, order yourself a copy. It's less than 100 pages long. It'll change your paradigm around money forever. If you're already working with us, if you already have this book, now is a great month. Spend 2.5 hours to go back and reread this. Studying the world of banking and how it affects your wealth plan is worth a fortune to everyone on the call. It is well worth your time to spend another 2.5 hours to read this book, and it'll reframe your thinking every single time you do it. Yeah. All right, so let's talk about the players in the money game. I think all of us are aware of this guy, Robert Kiyosaki. He has a really popular book, Cash Flow Quadrant, where we learned there's essentially 4 players in the money game we were all taught to be. You can be an employee, you can be self-employed, you can get into business for yourself, you can become an investor. Now, the cool part is everyone on the call has a current net worth. You're at a current point financially. We all want to go to a different point financially in the future. And the goal is, how do I get there in less time with less risk? Well, the nice thing is you can win the money game regardless of which player in the money game you choose. Yeah. We have clients that are employees, W-2 income earners that are very wealthy. We work with investors, business owners, self-employed individuals. All of these people are capable of building wealth. Now, what's interesting about this, the first time I learned about this, David, the question got brought up from actually an orthodontist who was a business owner and an investor teaching a class that I attended. And he said, you know, all of us are in business for ourselves. We're all investing. We're buying x-ray equipment. We're trying to build our businesses. We're trying to buy real estate. But who is owning this banking function in your life? And it was a question that no one in the room had an answer for. It was almost like, I don't even understand what you just asked me. Yeah. Because I'm a business owner, I'm an investor, I'm an employee, whatever that is. But here's the reality, David. All 4 of these players in the money game, they all need and depend on the banker for some type of financial play in their life. Yeah. I'm telling you, once you see this, you cannot unsee this ever again. Because if we break this down further, banking, this conversation we're talking tonight, like you said, is a control conversation. What are savers and borrowers always focused on, David?
And basically new money. How do we make new money? By borrowing or by saving and having some yield back? And they will all be familiar with all the products, CDs, high yield savings accounts, savings and checking accounts. The borrower will understand credit cards, mortgages, personal loans, auto loans. The products are all so obvious, but what they don't see is that the rails of the economy are going all pointed back to the bank to have control.
So let's role play this a little bit. You're the saver, you're the borrower. You are so focused on buying real estate, increasing your income, making more sales in your business, marketing better, finding products that produce income. Everything that you're doing as an employee, a self-employed individual, business owner, or investor is all centered around creating new money in your life. Now, if I'm the banker in this situation, I really don't care what you do as long as I can permanently control the money that's flowing through your business. Yes. The banks don't really care what you go do. They don't care if you finance a car. They don't care if you pay cash. Why? Because the dollars inevitably end up flowing through their system. Yes. Think about that for a second. Why are banks some of the most successful financial institutions in the planet? Why are their returns, in the thousands of percents? Because they understand this world of banking, and they don't necessarily want you to understand this, because when you can do this for yourself, they essentially lose a customer for life. Yeah. I think the frustrating part for me, David, when I read this book, and the one I read after becoming a banker was The Pirates of Manhattan by Barry Dyke. It frustrated me because I felt like I had been taken advantage of financially my entire life. These banks, with all the money that I was helping them create, they gave me little to no benefit in return. Yeah. 0.03% on a checking or savings account, dumb sucker every time I walked into the building. Like, that's pretty much the extent of the benefits I was receiving.
And the scale of it is overwhelming. That same book talks about the fact that banks provide 50 trillion with a T. 50 trillion of liquidity to markets in the United States. But where's that liquidity coming from? Again, it's fascinating to think about how significant the role they play is, but more significant than it is that all of us are participating without understanding what role we're playing in that economy.
We are playing in this game as bystanders. Yeah. And the banks are sitting right there in the middle, controlling this entire flow. So let's talk about how to solve that problem then, David.
Yes.
Now, this is an American spending problem. And this is kind of right out of Nelson's book, right? He said, average person's going to spend about 20% of their income on automobiles, 30% on housing, 45% on lifestyle, and they're saving 5% of their income. So you got 95% of the money that's flowing through your hands just being spent. It's gone forever. And we got this 5% over here that's being saved. And you know what typical financial planning would go towards is a financial advisor would come to you and say, David, take that 5% you're saving and let's get a 10, 12, 14% return on it. Let's make that 5% go faster. Yeah. The banks are looking at this saying, yes, go do that. Don't focus on the 95% that's inevitably flowing back into our world. Yeah. This is a control conversation. So if you're thinking on here, man, how does this work with my investing? This is the exact opposite function of investing. Investing is about taking risk and creating new money. Banking is about controlling everything you see on your screen that's in red to the left of your savings. How do we get more efficient with the dollars that are going to flow through our hands? And maybe we isolate this and just talk about vehicles, which is something everyone on the call has done tonight, which is owned and driven cars. Whether you paid cash or finance, let's talk about how to be more efficient with that activity, David, by changing a couple things. Where we're going to store our cash and the banker's mentality. We got to stop looking at large transactions like a business owner, an investor, or a consumer. We got to start looking at this as an opportunity to become the banker for these purchases.
Yeah. So as we talk about autos, you know, we typically put in front of all of you, this book would do the same, you know. The most common ways in which people finance the purchase of vehicles, which is something we all do, is either by being the saver and paying with cash or by being the borrower and thinking about financing or taking a loan to buy that vehicle. None of us are asking, hey, how do banks finance these things through other alternative methods? This likely represents 90% of Americans, by the way. And the conversation will be a conversation between benefits and costs. And both sides will think the other side is wrong, by the way, which is really interesting as a conversation. The person that pays with cash will say, well, I'd rather use cash. I don't want to have any payments. Kyle, you know what I hate? Making interest payments to a bank because it's going to take additional money. And the borrower will say, well, I'd rather use my money for an investment, which I'm okay with having a loan and having leverage to make that purchase. And none of these arguments are wrong, by the way. They're accurate arguments, but we need to zoom out and understand the overall cost and the overall impact to our wealth plan. The question that narrows your focus to understand this, which will be a gut check for all of us, is after all your auto purchases, doesn't matter if you're in car 1, 2, 3, 4, 5, 10, how much of that money do you still control? How much permanent control do you have of the money you've used to buy vehicles? And I don't think we need more than 5 seconds for all of us to arrive to the same answer, which is interesting. And we've done this in rooms with hundreds of people. The answer we all arrive quickly is zero. Zero. And if you want a visual representation of this, let us give you one. The borrower at the bottom in the red line will immediately use a loan, will immediately use leverage to take a loan and pay and buy a car and pay that loan with future income, principal, and interest over and over and over again. Once they pay the car, you always joke about this, they go and trade that card in, they use it as a down payment, and they will take the next loan, and we do it over and over and over, Kyle. The saver looks at that and said, well, you're paying interest. I don't want to pay that much in interest. I'm going to have the patience of delaying this purchase. I'm going to accumulate this money on a savings account, for example. And once I have that number, I'm going to draw that balance. I'm going to buy my car. And the next month, I'm going to start the savings process all over again, over and over and over. The interesting thing is that these two individuals are not wrong or right. They're just driving in the same direction. They're transferring all the money to a third banking organization, Kyle.
And I guess the banker's mentality of this, they don't really care if you pay cash or you finance. The money will inevitably flow back into a system they have created.
Yes.
That's something you got to really put on your radar. They don't care if you finance or pay cash because either way, you're going to bring the money right to them anyways.
Yes.
It's this world, you got to study this world of banking, how it affects your wealth plan.
Yeah.
So if we go a little bit deeper, David, because it actually gets worse.
Yes.
As depressing as that was to go through, it gets worse, right? We're going to give you some hope by the end of this. But if you look at this constant compounding, compounding works for you and it also works against you. The saver and the borrower, it doesn't just cost you the price of that car. Like Nelson said, it costs you what that cash or what that payment could have earned you if you would have kept permanent control of it in an environment that was guaranteed to earn you interest. So visually, this is what's happening if you apply time to this equation. People that are paying cash for their vehicles or borrowing conventionally are also compounding wealth away from them, and this becomes a multi-million-dollar lost opportunity cost. It's not just the price of the vehicle, it's what could that wealth have built for you over the exact same time frame. So when you look at this, there are effects to these buying decisions because we don't save in the right environments and we don't keep a banker's mentality. So in order to reverse that, we have to change our thinking. You got to think differently. You need tough money habits. You got to save more money. You got to get it in different environments that offer you more benefits. And then you got to start treating your money like a bank. Banks would never lend out money unless more money was going to flow back in there some way, somehow. They are masters at control. And if you understand how to permanently control dollars in your life and you go buy vehicles, which we'll send everyone a video after the end of the call, part of the follow-up for this, we'll show you one of our most popular videos, which is how to finance your own vehicles and keep over $1 million in your control. But you can't do it with typical checking and savings accounts, and you can't do it thinking like a business owner, investor, or consumer. You got to change where you save, and you got to change your mindset around money. You got to start thinking like a banker. If you do, you will keep this constant compounding in your favor, and that number that you've been chasing, I need to be worth an extra $1 million in the next 5 years. This number will start to come closer to you for things you are going to do anyways.
Yeah. The equation for the average American, if you want to take it there, Kyle, it's the average American will buy around 13 vehicles about their lifetime. Same financing, by the way, it doesn't matter if it's cars, it doesn't matter what we're buying. It's the financing piece, the banking piece that matters here. Financing 13 vehicles, same event can look two ways. If we behave like the borrower and the saver, we're going to spend around $400,000 and end up with $0 in permanent control. Or we start to understand this paradigm of the proper liquidity with proper savings environments. Same purchase, $400,000, and end up with over $1.5 million of permanently controlled dollars. The math will come in the video we're going to send you, and we're going to put this into context using Nelson's example. So if you go to the next page, the action item number 1 is to reread the book. And we're going to narrow your focus to part 3 of the book, which is what Nelson calls how to start building your own banking system, Kyle. And he will use 5 different methods of financing vehicles over a lifetime to put this into perspective. We are going to give you a visual summary of this chapter, and we want you to reread it so it changes the way you look at it and raises your urgency for why you should control more money moving forward. So Kyle, the summary of the chapter is in this page, right? 5 different methods to finance the same amount of vehicles. From left to right, method A, B, C, D, E, okay? The first one is a lease, okay? Nelson proposes in the book that lease would be the most expensive way to finance vehicles because some people that sell leases are profitable and they use debt or they use loans to acquire those vehicles. So lease must be the most expensive. Method B is using a bank loan. Method C is using cash. You'll notice there's a box there that says 90% of the population will only focus on those 3 alternatives, by the way. Why? I am going to say it out loud, although my phone is listening. I think it's very intentional that the powers that be want to control more of our money. That's the reality.
That's exactly it.
And then methods D and E, 4 and 5, are what Nelson calls capitalization strategies. How do we use assets to finance everything in life that provides more benefits? Method D is using something like a CD or a bank product, still owned by a third-party organization. Method E, which is why we are all on this call, is how do we implement the infinite banking concept using a properly signed whole life insurance policy to own the banking function in an asset that we own and control, Kyle. The graph speaks for itself. The first 3 are below 0, which is a negative cost or compounding money negatively. And once you move to a capitalization strategy, you're going to now move to the positive. Obviously, IBC and whole life insurance yielding the best result because it's the most effective way to have permanent control, Kyle.
It is the strongest banking tool. So let's take a look at this. And while we're doing this, if you wouldn't mind putting it in the chat, because I think the longer you own whole life insurance, which I think is the toughest asset, that'll be our conversation for next month. And the more you study about the world of banking and how to control that function in your life, the more wealth you naturally keep on your side of the wealth equation. And the longer you do this, the more you can look back and be like, oh my gosh, I wish I would have implemented this 20 years ago. Yeah. Probably the number one thing that we hear when we teach live is, I wish I would have known this concept and these principles and frameworks as early in life as possible. Yeah. So if we're looking at this, the first 4 years of someone buying a vehicle, regardless of what the vehicle costs, there's a capitalization phase, and then you're always in a state of constantly interrupting any type of growth. You either go into debt, which means you're already negative, or you save up and you save up cash, and then you deplete your account down to zero, and you repeat the process. And I'd love to know in the chat, how long has anyone on the call been owning whole life insurance and been utilizing infinite banking? Because as soon as you start that process, your wealth plan no longer looks like this. This is what 90%, if not more, of the US population is doing with a large purchase like vehicles. And they create no wealth doing this. You're always in a state of wealth interruption, constantly compounding wealth against your wealth plan. Yeah. So I'd love to know in the chat, how long have people been?
I have 10 years. Jared Schwab, thank you for being here, brother. 6.5 years. David Forbes, 10 years. Ken Crater, 7. Jeff Nielsen, 12. An OG, Jeff.
Dang.
Paul McHale, 11 years. 7 of banking. Brian Fleming, 14. Brian, winning chicken dinner. Michael Hessian, 12 years. Nicole, 6 years. Nicole Tate. Joshua Rose, 4. Ready to start, says D. Rencho. Glad you're here. Grateful to have you here this evening and learning this idea. Matt, 1 week. Wonderful that you're here, brother. That's exciting.
I love it. I mean, once you see this, you can't unsee it, right? Whether you use cash or credit, you must finance everything you buy. You either pay up interest or you give up interest, and it's because we never think like bankers. Banks don't care which one this is. They're going to end up with controlling the money anyways.
Jacob Howerton says, haven't owned any whole life policy, ready to start this. Grateful you're here. Thank you. And Justin Kaufman, I need to start also. Love it. Love it. Hey, the chart below, the chart before, I just want to make a little point here as we transition to the point that you're going to make, Kyle, which is this. The next one. This is how most people think about it. And this is what most people focus on, the payment. What is the payment motion? Okay, the lease is just a constant transfer of money every month. The lease is the same. The debt is going to be we draw a balance and we pay it over with future income, with principal and interest. This hopefully looks familiar. You probably have seen this in every chart we have in our education, right? But the cumulative effect of this using real numbers is what actually raises the urgency in this conversation, Kyle. So I'll let you take it there.
So if we look at the lifetime financing, the graph we're looking at here, notice the starting point up in the top left. We're tracking $0 and below. Yeah. Every vehicle purchase we make, whether we pay cash or finance using someone else's bank, is a zero-sum game. It's a lose-lose situation. Like, I think people try to get creative, David, and they say, well, I'm going to pay cash instead of finance, so I save myself the interest payment. It doesn't really matter. You still end up negative. We're just trying to figure out who's less negative.
Yes.
That is not a winning conversation. In order to get above this, we have to change the environments that we're going to source our cash from. And we've got to start thinking about controlling more of those dollars like bankers. I hate even looking at this slide because it's like, it makes no sense to argue with people over, do you pay cash or do you finance? It doesn't matter. You're negative in both situations. It's just by how much, right? So if we're going to use cash in a bank, lease, or just straight cash, walk across to the dealership and pay cash, one is just more negative than the other.
Yeah. Now look at the magnitude in comparison, Kyle. Go one more. This is the same chart, but now above the 0 line, we're adding a blue line that would represent the CD performance or the CD permanent control. And the yellow area is the whole life IC method, okay? I don't have to say much, but hopefully this chart, it speaks for itself. If you've read that book and you read that part of the book and it wasn't very clear, reread the book with this in your memory. It will raise the urgency for you to say, it's not only costing me interest payments or a lease payment or even the cash, is that we are not doing it slightly different. We're doing the complete opposite at a magnitude that is dramatic. compounding money positively without interruption will have an exponential effect that you cannot calculate in your mind. We think linearly, not exponentially. This chart puts in perspective. I put this together years ago trying to understand this book and to explain it to my wife. And the moment I show Sarah this image, she understood the urgency for why we needed more permanent control, more policies, more premium. Because the effect would have in our lives over a long period of time, by the way, it's not 2, 3, 5 years, is the rest of our lifetime, God willing, very long, is going to be dramatic. An extra point here, Kyle, that star at the top of the CD is the assumption Nelson makes about now starting to take withdrawals or taking consumption of that asset. And the CD runs out of steam very quickly.
That's why.
The same point, the life insurance policy is starting to provide income, and look at that, the cash value continues to grow. I want to make that point, and I wanted to put that star there for the following reason. We're having a conversation about banking, and the way that it applies to you and me in the first 5, 10 years may be very different than the way it applies to you in your second decade and your third decade at passive income time. This is such a versatile asset that likely all of us misunderstand and misrepresent how it's going to be useful in later stages of life, all the way to legacy. But hopefully this image doesn't leave you. When you're rereading this book, you're going to see a complete different perspective on how it may apply to you for you to have permanent control.
Well said, David. And cool. So what are our options? We keep making major purchases like we've been taught, pay cash, finance everything with a bank, and we are negative. It's just how many hundreds of thousands of dollars are we negative on our wealth plan? Or we become our own banker, we save in more powerful savings environments that give us more benefits, and the difference is well over $1 million spread for your wealth plan for something you are going to do anyways, which is buy, own, and drive vehicles.
Yes.
Like, this is, when I read the book, same thing. I went back and I had to bring this to my family because I was like, I'm one of 11 kids. That's a lot of vehicles purchased in a family.
Yeah.
I wanted all of that wealth control in my family's wealth plan forever.
Yeah.
It's a permanent control conversation. So you apply this to an individual and then you go, well, I got a spouse and she drives, and we got 4 little kids now. They're all going to drive. I'll tell you, banks look at that as future cash flow sources for them. And I'm like, I would rather have the relationship with my kids, so I want my family tying into our family banking business, which is what we spent over a decade building.
So quick parenthesis here, if you're LDS, if you're Catholic, if you have more than 4 kids, if you have more than 5 siblings, this conversation is more important to you than anyone else in the call, like Kyle just stated.
I think Nelson says that in the back of the book. This works even better for the Mormons, the Catholics, those with large families, right? I know Kent is thinking, oh, maybe I'll have one more kid.
Yes.
I know you, Kent. One more, one and done. All right, so let's go back and revisit this one more time, David, this permanent control. Money's flowing into our life. All of us have the skill set of creating new money. Whether you're an employee, a business owner, or investor, we have gotten good at making money, creating new money. Where we need some focus now is how do we permanently control that? That is an entirely different mindset. It's an entirely different skill set. And if we can do this well enough, David, understand how to permanently control money, becoming the banker. Imagine if you took that car example we just spent a few minutes talking about and you applied it to an investing strategy where now you're buying assets, maybe it's real estate, that lowers your taxes, produces cash flow, and appreciates in value over time. Imagine coupling this banking strategy with a solid investment or acceleration strategy, which will then create more new money through your investments that can flow right down into your income statement, path of money to be permanently controlled in the future. I think this is when people understand this banking conversation and they go, oh my gosh, I've been financing every investment I ever owned. I could have been doing both of these at the same time. And that number becomes an exponential wealth creator on your wealth plan.
And I'll connect it to last month's idea, right? Creating new money through the money that we work for with our time has limitations. At some point, we can only earn so much and only have so much time. And the solution for that is permanent control. Funny enough, permanent control opens the door to create more new money by being able to allocate capital, deploy capital, invest, and set us free. That new money that comes from our investments is what actually creates that freedom number that we all want to achieve. But the proper sequence in the proper proportions or amounts and not getting out of order, it's what's going to dictate the relationship between financial pressure, financial well-being with this path of money, Kyle.
That's it. So let's ask ourselves a more enlightening question, a fun question. I'll tell you, everyone on the call, your current net worth, whatever your current financial situation is right now, it will only go up from here.
Yeah.
When you're in the right rooms, the right communities where people are talking about ideas, you will become wealthier. Put yourself in better rooms and you will be making more money in the future. So now that we have potentially some new education, we know we can make better decisions in the future. That's the encouraging part. So if we said, hey, in the next 10 years, if you added all the money that you're gonna earn and everyone's income should be going up when you're in the right rooms, how much of it do you want to permanently control? So if we go back the last 10 years and your answer was 5% like it is for every American, I've had $1 million flow through my hands in 10 years and I have kept 10 or 5% of it permanently, right? That's still in my control. If we go the next 10 years, if you're going to make $100,000 a year, 150, 500, whatever your income is, how much money is going to flow through your hands and how much of it do you want to permanently control as a percentage? I hope that number is 10, 20, or 30% minimum.
Yes.
No one's answer should be 5%. We work way too hard to only keep 5% of that. And, you know, if we're looking at someone's path of money sheet like this person's worth 840, they want to go to a $3 million net worth, they got $50,000 of liquidity, making $150,000 per year. I love this model, by the way, David. It is so easy to orient yourself to exactly what's going on in my financial world by looking at a path of money analysis like this.
If I may be very direct with all of you, action item number 2, action item number 1, read the book. Action item number 2, please work with your agent on getting very clear about this path of money, because what we can do is give you perspective and guidance. And I'm going to actually put a price tag to that guidance, Kyle. If you run that calculation for that question you just asked, it's a very simple question. If you make $150,000 like this family over the next 10 years, $1.5 million, and you want to keep 30% of that, you are going to keep permanent control over $450,000. And I will tell you this with the utmost confidence from our team. Any one of us that is serving your family is worth to you that to your family, $450,000 of value into the future, because all of us can deliver on that guarantee that we can teach you by teaching you financial management and tough money habits, the banking ideas and the banking activity, and how to implement life insurance, how to permanently control that money, that amount of money that you just wrote down on your page. It's very difficult, and you say this all the time to me, it's very difficult to sometimes put a value number into your estate planning attorney or a CPA, right? But I can tell you, from our perspective as wealth strategists for your team, we know very clearly how to help you keep permanent control of that amount of money if that's your intention, because we have the tools and systems we're teaching you through this summer series.
10 years are going to go by, 20 years, 5 years. How much money do you want to permanently control? Everyone on the call is doing this already. That's the crazy part. It's not like you're not going to get into we're not even talking investing right now. We're purely talking money that's flowing through that you're going to control. You can't do it with normal savings environments, and you can't do it without understanding the world of banking. So one more visual, David, and then I think we have enough time. We should jump over to a max potential calculator and maybe do like a live example for this. I think that'd be cool.
Okay.
So if we up the ante, we were looking at a family making $150,000 a year. If we go top 5% American family, that's a family earning about $260,000 a year as a household. The more money you make, the more exponential this process becomes for you. The leverage for you is just exponential. So what we're looking at here are a few different, it's the same family with different savings habits who understand banking at a different level. That's all we're looking at. So at the very bottom, if you got a family saving 5% of their income that has no thoughtful criteria on where to save money, they're just keeping their cash at Chase Bank, getting little to no benefit. That's the amount of money that they would keep from all the dollars that are flowing through their hands. And this is calculated in millions. If we go a 5% savings and just change the environment that they're going to store it in, they would automatically double the amount of wealth they would keep in their wealth plan.
Yeah.
If you now get tougher money management habits, like Nelson would say, beat Parkinson's law, the human behavior, save more money and get that stored in the right environment, you're going to see an exponential wealth increase as well. Once you really get dialed in here and you say, I'm going to take wealth building seriously, this is important and it's urgent for me, I'm going to get 30% of my income saved, I'm going to get it into whole life insurance, and I'm going to become a banker. Look at that jump from 1.9 million up to 5 million bucks. That was a $3 million play for that family by just doing that. Yeah. And then at the top, why am I obsessed with infinite banking? Like, why did I come into this as a career? Because when I saw this, I was like, this is something I could teach for the rest of my life. Because when you understand, I need to be getting 50% of my income into those policies, and I need to be controlling every potential banking opportunity, vehicles, mortgages, investments, taxes. If I can get all of that into my control, and that might take me 15 or 20 years to do, David, it is worth $8.6 million for this family. We're not even really talking investing in here. This is purely a control. This is dollars that are going to flow through your hands. So remember, if you're trying to wrap your head around permanent control, banking function, the formula is get the right amount of liquidity, your cash reserves, in the right savings environment, and you're pretty much there. You only got to change a couple things to your wealth plan, and this is what your financial life will start to look like.
Yeah. We're giving you the template. We're giving you the map. Last month, we gave you some very specific insights into how to think about your financial management, the stages where you are, what your next best opportunity may be. Follow up with a conversation with one of our agents, which will give you a more specific answer to what can be more appropriate for your situation. The moment you pair those habits with, hey, I want to make sure I control as much of my income as possible, and I want to build the cash reserves in the right environments. This, again, I'm going to say this again, Kyle, same family, same income, five very different outcomes, and it's a choice of where they store their liquidity and how much of it they get to permanently control. Hopefully this inspires you and gives you urgency in how important this conversation is for you. So we have 10 minutes or so, Kyle. I'm going to open the chat for some questions. If you want to pull that Truth Concepts calculator, we can do that.
Let's
and then we'll have a quick chat. Any questions, please put them in the chat as they come in. I'll read them. I'll let you tell a story here around the other visualization we can have around this, Kyle.
All right, let's just do a quick recap of what we learned tonight. If we have, let's say, a 40-year-old, and we're going to track this over 30 more years, and this 40-year-old is making $150,000 a year, which was the family we were tracking. If we could just save 100% of their income, which is the first idea we talked about tonight, that means $4.5 million is going to flow through this individual's hands, and they're saving all of it, right? Now, if we just take that savings and we apply a 4% earnings rate on it, if we can just get it stored in a more efficient environment, look at what that does to their wealth plan. It jumps up from $4.5 million to $8.7 million. Now, if you also increased how much income I'm going to make, if you get better at creating income, I'm going to give myself a 3% increase in my income every year. The total max potential for an individual that's going to increase their skill set and get their savings stored in the right environment, it jumps from $4.5 million, David, to almost $13 million. We don't think like this. Like, this is why your skill set, your habits affect your wealth plan. The environments you save wealth in affect it. The number that this is costing you to not do this is much greater than what you think it is the point I'm trying to make. Now, if we come back to reality and we say, yeah, but we got to pay taxes. Maybe 20% of our income is going to taxes. And maybe we have 30% of our income is going to debt. That could be vehicles, credit cards, student loans, mortgages. And maybe lifestyle is 40% and we're saving 10% of our income. You see, of that potential $12 million that was available to us, we're keeping $1.2 million of it. So everything below this line is what's going to other people. And this is why once you get intentional about this, you get on some of our wealth resources, our wealth scorecard. We have a team of professionals here that can help you with taxes, estate planning, anything in your financial world. If you start getting intentional and saying, you know what, if we could reduce our tax liability from 20% down to 17%, maybe you start paying your kids to work in the business, maybe you start segregating some of your real estate, and you can reduce some of your taxes and convert that to savings. If you were to do that with your debt, maybe you pay off your vehicles and you privately finance those into your banking system. We can drop the debt payment from 30 to 20%. We get rid of everything that's not the mortgage. If you go in and eliminate low value spending on your lifestyle, can we not reduce lifestyle, but convert low value spending away and just convert that. Now we're at a 30% savings rate. If that's all being financed and going through your private banking system, the number now that we're keeping is almost $4 million.
Yeah.
These are things that we have to do anyways, but we've never profited from them. Someone else's banking organization is more than happy to do everything we just talked about. We think that power, that control should be in the hands of us, the you and me level.
Yeah.
And to visually see what we kind of just spent 45 minutes talking about, we're seeing it on the calculator right now.
Yeah.
Now, the more you get into this, the more you realize you start getting creative on how much more money can I get flowing through my banking system, and that becomes an exponential wealth curve.
So you hear Kyle talk about intentional considerations on how to take permanent control. I think there's a perfect question for this, which comes up often in this conversation. Jared Schwab asked Kyle, I would like to understand more about the person making $250,000 a year. If they push 100% into the policies of their income, but only keep 30% in the policies and they leave off 70%, what would that look like? Basically running 100% of the income into policy first. He further adds, I have only seen this example when you save 10 to 35%. But what if we went to a whole life with 100% first and then lived out of 70% of the money? What are your thoughts there?
Nelson talks about that in his book, page 48. Should income and premiums be equal? I think it's an awesome idea. I have seen some people do it. I can tell you, you won't be able to do it in the first 3 to 5 years of owning whole life insurance. The guys and gals that are able to do this have 10, 15-year-old policies. Make sure you tune in next month. We're going to cover this a little bit. Your policies will get to a compounded effect where you can put in $1 and it's going to spit out way more than $1. At that time, could you run your entire income through a policy? Yes, you got to have a system big enough to do it. It can be challenging too if you're in a heavy growth state. If you're growing a lot, depends on how the policies were built too. I've seen people kind of get stuck with policies where their income wasn't rising fast enough to match that, so they're limited on their capacity to pay premiums. A lot of it is due to policy design. That could be something on there. So I love where you're going, Jared. Hypothetically, it is possible. I've only seen a few people ever do it. Me personally, I'm trying to get as much of my active income into my system of policies, which could be pushing 40, 50, 60%. Maybe in another 5 years, I might be able to get 100% of my income through premium. But even then, I think there is the question of, do we want to finance groceries? Mm-hmm. I think there is a point where you get enough done with banking, and the answer actually relies, let's go back to our path of money. The answer to that is right here in the investing part. If we could get like I would rather use my policies to grow my business, for marketing, to buy real estate, and get more assets that are producing income to actually make it impossible to get 100% of my income into premium. So I love where you're going. We could have a lot of fun illustrating that. I think the reality is it's going to be difficult for a lot of people to actually do that. But I love that the idea is in Nelson's book.
Yeah. And if you use 100% of your income and then you have to access the policy, more money is required for interest. So it becomes a drag conversation, and it depends on your financial statement, the age, and how long you've been doing banking, like you said, Kyle. When your passive income takes over your actual active income and it's significantly larger, somebody earning a significant amount of money, the equation may be different. So not something we should dismiss, but from practical purposes in the conversation we're having today is, how can we make this even better? How can we make this even better, continuing that progression? So Jared, thank you for being here and for your question. Always a pleasure having you, brother. I'm going to bring Carol's question here. Carol, bless you, Carol. She says, any option for an 80-year-old with no heirs? It's a wonderful, beautiful question. And God bless you, Carol. Thank you for being here with us. I'll start by saying this, and I'll let you share, Kyle. Carol, maybe you don't have any heirs, but maybe there's people that you have an insurable interest in that could be part of your plan for what do you do with your assets moving forward to get significance, legacy, right? Banking is an idea that can be implemented, and the implementation requires a product that must insure somebody. It doesn't have to be you necessarily if you're not insurable or if you're not age where you're not able to access the coverage on yourself. But Kyle, myself, many people on the call, we own life insurance policies on ourselves, on our spouses, on our children, on our parents, as a way to keep control of this money in assets we own and we have, again, control of. So There has to be a conversation, Carol, between us where we can talk specifically, or with your agent, of course, is what I mean, where you can maybe we have the opportunity to ask you some questions and understand more of your path of money and your situation. And maybe we get creative and give you some alternatives, some options. Anything else that you would add there?
Nope, I think you've got it. As long as we can find an insurable interest, there's always a way.
Carol, thank you for being here. Bless you for joining us this evening. And if you need any support, our team will be here with you, giving you some ideas. Jared says, thank you. David and I have talked about me doing it, but I haven't seen the math. We should take a look at it. Absolutely, brother. We'd love to geek out with you. No more questions in the chat. I would love to remind everyone of action item number 3, which you have here on the screen, Kyle. Action item number 3. So 1, read the book. Read the book if you have already. Number 2, please, please, please take us up on this. We're worth hundreds of thousands of dollars to you as members of your team. Let's work on a path of money, and let's get clear about how much permanent control you want moving forward based on the strategy you're going to set up to implement infinite banking. Action item number 3, join us for part 3 of this series. We're going to do a deep dive on whole life insurance as the toughest asset. You're going to leave understanding what the foundation of your wealth plan should be for you to have more certainty, more control, and to maximize the benefits that you enjoy for your money. I have to be completely honest with all of you. Colombia is about to play at 7 p.m. in the World Cup, so we cannot go any minute past 7 p.m. But if there's any other questions, we'd love to stay with you, of course.
You get out here, David. I will take it from here.
Any other questions?
Hey, Kyle, I would just so be on the lookout. You had a conversation that even an 8-year-old could understand.
Yes.
And wouldn't it be fun to have an opportunity to talk to an 8-year-old and see if how they understand this process?
Yes.
Any thoughts on that?
Yeah, we do have a special class coming up at the end of July. It'll be in addition to our normal monthly educational class. It's eldest son Riker has had policies for, since he was 2-3 weeks old. And so we're going to do a review father to son. I'm reading a book right now called The Intentional Father. It's really given me some good frameworks to talk about with my kids and what I want them to learn about the big wide world. So if you want to see infinite banking, whole life insurance, tough money habits in the eyes and understanding of an 8-year-old, we'd love love to have you join that conversation. We're going to do it in our home. We won't be in the studio. We'll be on the couch, probably with some of the other ones running around yelling. So we're going to do it family style. And so if you want to join us, we'd love to have you. We'll make sure that everyone registered for this gets a special invite to that class as well.
Hey, I'll make a point to your question, Wade. The reason we use the same tools with your 8-year-old in a board of director meeting or business partners is because we are an educational company. These colorful boxes, these arrows, they are a way for this information to become memorable. You will not be able to unsee the path of money. It will be the way you speak to your family, sitting on the same side of the booth looking forward. It's a framework to think about it, of a very complex idea, to bring it in simple terms that gives you clarity, perspective, and guidance. So that's why we use those tools, Wade.
I love it. Well, we appreciate everyone hopping on the call tonight, spending an hour with us. You all get back to those wonderful families. Enjoy the rest of your evening. We'll have some resources sent out to everyone after this, and we'll see everyone next month to talk about the toughest asset you can place at the foundation of your wealth plan. Thank you again.
Dean, before you hang up, Becoming Your Own Banker, the name of the book, Dean, by Nelson Nash. Becoming Your Own Banker. Dean, thank you for being here, for your question. Thank you all. Blessings to all of you. Have a great evening.
Thanks, everybody. Thanks, Cal.
Thank you, guys.